Welcome back to our special Global Jitters. Is the period of easy money over? Is the question we are asking. We saw a decent amount of cuts on Wall Street on Friday evening and across the globe today. Asian markets, Indian markets and European markets all shedding between 1.5% and 3%. Is this just a correction? Is it a reversal? Will cheap money or easy money become hard to come by? Those are the questions we're asking, and joining us now is market expert Jyotivardhan Jaipuria. Jyoti, good afternoon, and thank you very much for joining us. Well, that really is the question. Do you think this global jitters that have always been rewarding if you bought them will again behave exactly as they did in previous occasions on Brexit and other occasions, buy the dips?
Yeah, in some sense, I think if you're a long-term investor over the next 2-3 years, I think it's still buy the dip. But, the only point I'll make is, like you started with, is the global easy money over? So I think, there are two legs to this global easy money. And it all started in early 2009 when, central banks across the world in a very synchronized manner were easing interest rates and, were flooding the world with liquidity. We know that at least one leg of it now is going to change, which is US. Even if they don't increase interest rates, US is no longer going to cut interest rates. They're no longer going to pump in liquidity. So now it's going to be a diverse monetary policy compared to a synchronized monetary policy we've got used to for the last 5-6 years.
Hi Jyoti, good evening. You said from a 2 to 3 year perspective it makes sense to buy the dips. What about from a 6 months to 1 year time horizon? How were you reading it then? As Latha asked, is it just a correction or do you see a reversal?
So, I would say even from a 1 year perspective, we'll probably still get a positive return from these levels. It may not be a very high positive return, but it's still going to be a positive return because I think, the earnings growth trajectory in India is just starting to turn. So we've so far not really seen much of earnings growth come through, but I think slowly starting to turn. So by the time we are into late 2017, we'll probably have more visible signs of earnings growth, which is in double digit, which is 10% plus. If you're lucky, it could be as high as 15%. So to that extent, we're going to see the markets give a positive return over the 1 year. Now, the question which someone may ask is, can I get the market cheaper? Yeah, you probably can, because markets are expensive today. Some of these things are going to take time, and as we've seen over the last 2 years, the earnings recovery has just kept getting postponed. So you probably can get the market cheaper. I think you'll have a price correction as well as a time correction in the market. So it is like, how you want to really play that correction. Maybe you can sell a bit, keep a bit in cash, and then try and invest it when things get cheaper.
Well, actually, that is the most difficult question, isn't it, Jyoti? If we had bought the markets 18 months ago, say last March or April, we would have made no money at all as of today. But if we had bought it in January or February, we would be making money. So people will really want to know whether this is the time to buy or, 3 months down the line or 1 month down the line. Let me put the same question differently. What would you start buying already now? Are there stocks which look attractive, or as the market dips, which will be the first area you will enter?
Okay, so like if you think about it, we've had markets correct for only 2 days. So, there's been hardly a correction. Markets are up 25% since February end. So to that extent, what we've seen is just a very, very minor blip so far. The correction, this can't even be called a correction. Like, if markets don't fall more, it's like when you look at the chart 2 months later, you'll not even notice the blip which came now. So to that extent, you're probably going to see, if there is a correction, it has to be a little deeper than that. I think, the mid caps are the area which I like, but mid caps are the area which probably are more expensive than the large cap. They are the area which have a tendency to correct much faster. So, you could see mid caps come off 15%, 20% from where they were, let's say, last week. And that's the area then you can, start saying, okay, I've got these 20% pullbacks, I've got a 15% pullback, and that's what I really want to buy.
Okay, very quickly, which are the specific sectors? Would they rather be mid caps?
Okay, so in terms of specific sectors, I like the consumer names. And within consumer, I think the rural consumer is going to do even better than the urban consumer. But I think both are good. So rural consumer as well as urban consumer is a area I like, and you have a whole range of sectors there. I prefer the autos. In fact, tractors and the other autos are something which I like the most among the big caps. The other thing I like is still people who are gaining from commodity prices having been lower. So, a whole lot of plastic processing names, people who are gaining from oil prices have come down. So that's, another area which I like quite a bit.
All right, Jyoti, unfortunately out of time, but that's useful advice for sure. Thank you very much for joining us with your thoughts on when and what you might buy in this jitter that we have seen today. Let's see whether it's just a jitter or whether it's a major correction that we can take advantage of. We wrap up this edition of Global Jitters. On that note, it's back to news in a minute.